Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Mike Swanson, editor of WallStreetWindow.com. Welcome back to the show, Mike.
Oh, it's great to talk with you. It's an interesting time for sure. In some ways, not a whole lot different has happened since we last spoke 2 weeks ago, but there is some interesting news today, and it is interesting how the markets are trading in regards to it.
And that news would be?
Yeah, so today, before the opening bell, the U.S. government released its consumer price inflation numbers, and they jumped higher than expected, showing that annualized consumer prices in the United States went up 5.4%. It's the biggest jump annualized since 2008. But what's kind of interesting about it is if you can think back to, let's say, 2 months ago, these numbers were first starting to come out when it comes to inflation, and gold sold off on it in June. Commodities in general had a pullback too. For instance, the agriculture commodities, lumber took a dive, corn dropped, and so forth. And there was a little bit of worries even inside some of the speculative stocks that make up the NASDAQ. They dipped in May, partly supposedly over worries about inflation. We were told that inflation's bad for technology stocks, good for real economy stocks, and that was an explanation for the money shift that was taking place inside the U.S. stock market into more cyclical issues. But today, the price action in all these markets is very muted when it comes to this news. The news, I would say, has been digested. It's been accepted now that inflation is going to be 5.4% now, but elevated above 2%. Now the Federal Reserve is predicting it's going to go back down. I guess there's people who believe that. I think it's kind of foolish to just believe statements that they make. Haven't been consistently proven to be correct in the past 20 years. But regardless, I want to step back and make one point. And in fact, it's such an important point that if you're just listening to this on your car and you're driving down the road, or if you're at home, it actually would make sense to stop whatever you're doing and write this down. It's going to sound like maybe an insignificant, not worthy to write down, but it's so basically simple, it's so important. And that is, while inflation is 5.4% annualized, and even if it went down to 2% as the Federal Reserve, some of these Fed officials predict, or the reality is the 10-year bond is yielding 1.37% as we speak, and you can't make any money off your CDs. You're lucky if you can get 0.4% payment on a CD. I mean, you can't make anything. And the point of this is to say that, look, you buy a 10-year treasury bond, you can't beat the inflation rate. You can't beat it. And this is probably one of going to be the defining factors influencing the markets, for years. And it's inflationary. When the rate of inflation is higher than what you can get to make on a CD or parking your money 10 years in something, even a junk bond, you'll have a tough time finding one of them that yields 5%. It has such huge ramifications for everything in the economy and the financial markets. It's one of the most important things happening now and going to keep happening.
So what does that mean as an investor? You have to speculate, or are there any so-called safe havens?
Well, I think the answer to that's both, which isn't much. It may not be satisfying, right? Or it may sound too simple. But the first part, to say you have to speculate, you do, because historically the bond market has been the safe haven for people. When stocks since 1980. Whenever the stock market would correct, bonds would go up. So a simple strategy of putting, let's say, half your money in bonds and half your money in stocks started to become widely popular around 1990 because it works, or it has worked. So that's great diversification. You don't want all your money in the stock market because if it falls, it's no fun. So having half your money in bonds was a great strategy, because when stocks would fall, bonds would typically go up. But now the problem is bonds, they trade opposite to interest rates, and if interest rates so low and really not much room to go much lower, there's no upside to bonds. So they're not going to act as a great safe haven the next time there's a bear market or even a 10% correction. You can't really count on the bond market to go up when stocks go down. And we saw this new reality take place in the first 3 months this year, when the NASDAQ fell a little over 10%, I think it was about 12, and the Treasury bonds dumped too. Both fell together in March. That's the first time that safe haven, let's put half my money in bonds, half of my money in stocks, failed to work since 1980. And that fact means that, yes, you now have to speculate, because if speculation means deviating from what just about every investment advisor in the United States is going to tell you need to do, half in bonds and half in stocks. So you got to find other things that will act as a safe haven. And, I think commodities is the answer. I believe commodities put in a secular low last year when we saw oil futures trade negative for a short period of time, but commodities are what goes up during times of inflation. And personally, what I'm doing is devoting roughly a third of all my money to gold, silver, and other commodities. I got a big position in this DBA agriculture ETF. I also own energy stocks, along with mining stocks. Energy stocks pay good dividends, and so forth. And there's some other sectors that tend to go up during times of inflation, such as REITs. I'm invested in REITs. Rents go up when inflation goes up, and REITs are among the best sectors to be invested in during the 1970s. The difficulty, though, is that at times bouts of volatility can hit everything. So it is a little bit more risky, I would say, environment than or could be, than what we've seen in the past. So navigating that can be very tricky. REITs, for example, if the stock market pulls back, they'll probably pull back too at the same rate. So you kind of want to try to find things that aren't so volatile to invest in. Gold, I would suggest, even though a lot of Americans are completely asleep on gold, if you have a Robinhood account, and you're listening to this, log into the Robinhood account, look at the top 100 list. Not a single gold stock is on the list, or precious metals fund. But one of the interesting things about gold is it's not that volatile. Yes, the mining stocks are, but the metal itself really isn't. I mean, we just had a pullback in June of, let's say, 1925 to 1750, and that's a pullback of about 10%. It's not enormous, but that's kind of the type of pullback you'll see in gold. And last year when the stock market completely crashed, gold fell less than the stock market did. And I think that's going to be the story for gold going forward, that when it'll pull back, it's less volatile now than the S&P 500. And trying to find things that are less volatile than the stock market, I think, is probably the best way to try to find safe havens and be diversified, because you just can't rely on the bond market anymore.
We'll have more with Mike Swanson right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Mike Swanson. Mike, if bonds aren't all that good and interest rates are very low, what's that doing to pension funds and insurance companies?
Well, it's causing them to struggle and also speculate, because they need to generate a return, and they do want to invest in interest-bearing securities. So one effect this has had is to create manic distortions in the overall financial system. If you look at the bond market, they can't, if they're trying to reach for yield, is the phrase. Well, to do it, they're being forced to buy junk bonds, just to get over 3% interest. And some of these junk bonds are extremely risky, and there's been so much money flowing into these junk bonds that junk bond ETFs such as J&K are hitting new highs. The yields on junk bonds have collapsed to lows. So people, unfortunately, money managers are being forced to take what I would consider to be more risky trades and situations. And, it's one of the reasons probably real estate's going up and REIT funds are going up, because they generate yields too. In junk bonds, people, they can justify to themselves buying something crazy like a Tesla bond or a space bond, that SpaceX company, or Netflix, money-losing companies that probably will never turn a dollar or a dime even of profit, but they issue junk bonds, and these funds will invest in them. We saw that last year with Norwegian cruise lines, and sometimes they can get sweetener deals and say, look, I'm a fund, or I'm representing a bunch of funds, and we're going to give you, in combination, hundreds of billions of dollars to keep you afloat, but we want a deal where if we so choose, we can cash these bonds in for stock and liquidate the stock to protect our initial investment. That's what's happening in much of the market, in areas of the market. We saw that deals such as that were made in the airline sector, where airlines were, issued all these billions of dollars worth of bonds, but the bondholders have the ability to press a button and get shares of stock and flood the entire market with it if they think, the prospects are going to worsen for bonds. And this is a risk factor for anyone who ends up buying airline stocks. I don't have one position one way or the other at the moment, but, I'm just pulling up Delta Airlines, down 3% today. Delta Airlines is trading at 42, trading at the moment right below its 200-day moving average, and several months ago it was at 52. So these highly indebted companies are helping the pension funds by issuing debt, but the shares are increasingly risky, and that's making them lag the S&P 500 and the rest of the stock market. So this is kind of like, I guess, part of the story in this answer I just gave you is that when you got inflation at 5%, 10-year bond yields at basically below 1.4, it creates a mega distortion in the entire financial system that creates pockets of strangeness and weirdness that show up, and this story about airlines is one of them.
Back in the late 70s, early 80s, when we had rampant inflation, interest rates were very high. I remember getting 21% on a Canadian government savings bond. There's no sign of interest rates climbing at all, is there?
Not now. There definitely is not. I mean, last month in June, there was a Federal Reserve meeting, and they made a big deal for a few moments that this is more hawkish talk. And, all they did was say, we may raise interest rates, or a few of the Fed officials talked about, in their projections, they may raise interest rates at the end of next year. And then if you look at the Fed fund futures markets, it doesn't even have a 50% chance of a rate hike in the next 12 months. But what they're more likely to do is possibly reduce their quantitative easing buying operation, basically slowly cut it in half. It appears as if we're heading to some sort of announcement such as that. And the thing about it is, this is where everything is so crazy, is that this will be presented as a hawkish move, on CNBC and other financial outlets, and especially, or Fed tidbits by the Fed. It'll be presented like this is hawkish Fed policy, when all they're really going to end up doing is cutting the number of mortgage-backed securities that they're buying. They're hardly at all going to reduce the number of treasury bonds they're buying, and they don't need to buy these mortgage securities because the real estate prices are just going up, and up every single month. And real estate prices are up 14% in the past 12 months. That's not even looking at the bottom. That's just the past 12 months since last July. They're skyrocketing, and it's going on not just in the United States, but all over the world. And this is causing inflation because it's making rents go up for people who can't afford their home or their apartment, as far as buying one, and they got to pay rent. And it's a massive amount of money, for people. And you do get a mortgage, you think, I'm getting a cheap mortgage. But are you? You're buying a high price for a house. So, it's completely distorted because of these low rates that, if they did raise them a quarter of a point, it wouldn't mean anything. But it does. I do think you mentioned the 1970s. That's going to ultimately, I believe, is sort of some version of that is what we're headed for. Because you look back to the 1970s, there was inflation in the late 60s in the United States, creeping up like 3%, sometimes even hitting 5%. And then the U.S. government debt grew and grew. The dollar fell in value. And there was a danger that the U.S. was going to lose its gold because we had the dollar backed by gold on the Bretton Woods Agreement since World War II. And Nixon took us off that around 71, 72. And then inflation creeped in about 2 years later, completely exploded, became a national issue, and as you mentioned, by 1980, interest rates went through the roof to stop all the inflation that was just completely out of control by then. I think that's what we're headed for. It's going to take years, though, to get to the point where they actually start to raise rates, because frankly, right now, people are happy with the situation as it is. They can live with 5% inflation as long as the stock market goes up. They're happy. You have two classes of people right in the United States. People with a lot of money in the stock market, they're happy when it goes up. People who don't have very much money, they're still happy when the stock market goes up. The Robin Hooders, because they can dream of getting rich, if it can continue for them the way they think. But you also got, at the moment, a lot of people don't have jobs still. It's been a struggling time, but they're getting the payouts or the government assistance. So as long as they can get their government assistance, they're content to, bear the inflation. But if inflation gets too high or one of these other two factors change, government assistance payments stop or don't go up to match inflation, or at some point the stock market declines, then there'll be another, anger, and calls to stop this will eventually come, much like what happened in the 1970s. But if this is comparable to the 1970s, this is like 1971. No one's really mad, at all when it comes to these type of issues. In fact, in politics, they hardly talk about them at all. It's all culture war. Right now, that's, they're trying to use to keep their bases engaged. And speaking of the Democrats and the so-called conservative Republicans, they're just culture war, and Trump, while inflation creeps higher and higher, but no one really wants to stop it for real. They may say they do, but they really don't. But this is where the kind of path we're on.
Didn't Bill Clinton get elected with the slogan, "It's the economy, stupid"?
Well, he did. And the thing about it is George Bush, who he beat, he had what he thought was a fun war in Iraq. And before that in Panama, he wiped out, he invaded Panama and got Noriega and put him in jail. And then a few months later, Iraq invaded Kuwait, and we had a war against Iraq, and his poll rating shot up to 80%. It was the first big video game wars that was presented on television, where you could see cameras attached to bombs and falling on buildings, and there's a lot of excitement. It generated huge ratings for CNN, and a lot of patriotic music and songs, and it was considered a fun war for everyone watching it. But his ratings just shot right back down when the Fed was raising interest rates at that time and slowed down the economy, and the stock market had a little bit mini bear market, and Clinton just came in on that with Perot as a third party candidate. But there was a lot of disaffection, which does show that it is, in the long run, it is the economy. But I do think it takes the stock market going down for people for the investors losing money to really get people upset enough to want to vote based on the economy.
What's going on with Bitcoin?
Oh, it's just gyrates. It's something that I think is also a lesson for us. About the way the markets are operating. When you have rates so below the rate of inflation and people just flood into speculations, there's a segment of people, I don't think of them as real investors, they're momentum traders that try, and this is the bulk of people with Robinhood accounts, this is how they're doing things. They look to see what's going up the most on their screens and then hop on, and they get into a herd. And places like Reddit, that's where the herd congregates to talk to each other. And Bitcoin was a herd trade, and crypto collectible coins too. They went up for Bitcoin was around 12,000 around election time last year, and went to 60,000 at the end of last year. There's less than 3 million people with Robinhood accounts in Bitcoin. By March, that number was close to 10 million. So there, like, over 60% of people with Robinhood accounts own Bitcoin by the end of March. They heard it in because they saw it go up. The problem with that type of trading is there's no thought at all about fundamental valuations. And when everyone that can possibly get in Robinhood is in, things peak out, and then you just got a bunch of people with losses, and they create overhang on the stock or asset, in this case, that you look at. So now, Bitcoin fell to 30,000 in May, and ever since, it's been dead money. It bounced up to 40 3 times, and now it's at 32,000. I believe it's the most likely thing is it'll crack 30 before the year's over and collapse. But and all these other crypto collectible coins will too, because there's no true fundamental value to them. The problem is it's not just crypto coins. You've seen the same thing happen with GameStop. In January, GameStop went up to 500 on a similar type play, and it became one of the top 5 most owned stocks on Robinhood. And all these people got losses and now is trading under 200. And the last one this sort of thing happened with is AMC Entertainment. You know, it was below 10 2 months ago and shot straight up to 75 in less than 10 days and went up to be the 4th most owned stock on Robinhood. The herd jumped in, it peaked, and now it's trading at 40. So this herd trading is madness. And if you look at the fundamentals of these companies, it's truly evident. As even though AMC has fallen already about 35% in 8 weeks, its price to sales ratio is 19. It's still one of the most highly valued stocks in the entire stock market. It's got a market cap of over $20 billion and loses close to $1 billion a year. It makes less. It loses $15 a share. It's one of the biggest money-losing stock situations I've ever seen in my life. But it's the 4th most owned stock on Robinhood. It's the same mentality that drove people to jump in crypto on the way up is what causes people to jump on AMC and continue to hold it. And this is just probably a trend that's going to keep going on, where these people try to jump on the next thing, and repeat this same sort of behavior until there's a real, 20% or so correction in the stock market, and then they might, get shaken up a little bit.
Mike, thank you so much for chatting with us.
Thank you. Great to talk with you as always.
My guest has been Mike Swanson, editor of WallStreetWindow.com. If you have any questions for Mike or any of our other guests, you can send them to info@HowStreet.com, our YouTube channel, Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.